Welcome to PhillipCapital's weekly Market Watch. With recent talks of global economic recovery and rallies in the equities market, is the financial crisis bottoming out? Today we have Mr. Wong Eng Soon from Phillip Futures Investment and Trading Department to share more. Over the past month, the view of slowing economic contraction has become more widely accepted. Do you agree?
Yes, I agree. The source of this financial disaster can be attributed to a fall in US residential housing prices, and currently this fall is showing signs of stabilization. US residential housing prices is becoming ultra cheap and affordable, and it is very attractive to investors. It is cheap because the median housing price to family income ratio has fallen from a peak of 4.15 to just 2.75, cheapest since the mid-1970s. It is affordable because the average mortgage payment is now just 14.4% of income, a record low and far below the 30 to 40% levels seen in the 1970s. When US residential housing prices pick up, US homeowners will have rising net worth and they'll be in a better position to consume more and lead a global recovery.
How about the pace of recovery in Asia?
Manufacturing production, the main source of economic weakness in Asia, appears to be stabilizing. The Korean inventory to shipment ratio has dropped to 1.13 in February from 1.26 in January on rising shipments and declining inventories due to the pickup in electronic components, mainly memory chips and integrated circuits. China's Purchasing Managers Index is now pointing to an expansion in manufacturing as it crossed to 52.4 in March from 49.0 in February and a record low of 38.8 in November 2008.
What are some of the risks to the current economic recovery?
There will be a massive number of new issues, IPOs and private placements for capital raising, and only the strongest will be successful. For instance, Goldman Sachs' US $5 billion offer of common shares. Many others will be unsuccessful, and the lack of funds to beef up corporate balance sheet will hinder expansion. Inflationary pressures will build up on the massive expansion in money supply, and when it kicks in, central banks will be forced to tighten up despite weak economic conditions, and this will slow down the recovery process.
With the first quarter corporate earnings not looking so good, what is the possible impact on recovery?
More needs to be done to stimulate consumption, investments, and government spendings to build up on the momentum of stabilizing economic fundamentals. Hopefully, with this continued fiscal and monetary stimulus, second quarter corporate earnings will be much more impressive than the first.
Thank you, Eng Soon, for your time. That's all we have for today. Join us next week for more market updates.